Today we're diving into the world of investment funds, focusing on two major types, hedge funds and mutual funds. Both play significant roles in the financial markets, but they operate in very different ways. Whether you're an aspiring investor or just curious about how these funds work, understanding their differences is crucial. In this video, we'll break down the basics, compare their structures, and highlight what sets them apart. Let's start by exploring what investment funds are and why they matter in the world of finance. Mutual funds are investment vehicles that pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. Managed by professional fund managers, mutual funds are designed to be accessible to the general public. They offer a simple way for individuals to invest in a broad range of assets without needing to pick individual stocks themselves. Mutual funds are regulated, transparent, and typically have lower minimum investment requirements, making them popular among everyday investors. Hedge funds are private investment partnerships that use pooled funds from accredited investors to pursue a wide range of investment strategies. Unlike mutual funds, hedge funds often employ complex techniques such as leverage, derivatives, and short selling to maximize returns. They are less regulated and typically require high minimum investments, making them accessible mainly to wealthy individuals and institutions. Hedge funds aim for higher returns but also come with higher risk. Structure of mutual funds and hedge funds is a key difference. Mutual funds are typically open-ended, meaning investors can buy or sell shares at the fund's net asset value at the end of each trading day. Hedge funds, on the other hand, are usually structured as limited partnerships with restricted entry and exit points. Investors may only be able to redeem their investments at specific intervals, such as quarterly or annually, making hedge funds less liquid. Mutual funds are open to the general public, allowing almost anyone to invest with relatively low minimum amounts. Hedge funds, however, are limited to accredited investors, those who meet specific income or net worth thresholds. This exclusivity is due to the higher risks and complex strategies involved in hedge fund investing. As a result, hedge funds cater to a more sophisticated and financially capable clientele. Regulation is another major difference. Mutual funds are heavily regulated by government agencies, such as the SEC in the United States, ensuring transparency and investor protection. They must disclose holdings, performance, and fees regularly. Hedge funds, in contrast, face fewer regulatory requirements. They have more freedom in their investment choices but less obligation to disclose information, which can make them riskier and less transparent to investors. Mutual funds generally follow straightforward investment strategies, such as buying and holding stocks or bonds for long-term growth. Hedge funds, however, are known for their flexibility and use of advanced strategies. These can include short selling, leverage, derivatives, and arbitrage. The goal is often to generate positive returns regardless of market conditions, but these strategies can also increase risk. When it comes to risk and return, mutual funds are generally considered safer, aiming for steady long-term growth. Hedge funds, on the other hand, often pursue higher returns by taking on more risk. Their aggressive strategies can lead to significant gains, but also substantial losses. Investors should carefully consider their risk tolerance before choosing between these two types of funds. These structures differ significantly between mutual funds and hedge funds. Mutual funds typically charge a management fee, which is a percentage of assets under management and sometimes a sales load. Hedge funds, however, often use a 2 and 20 model, charging 2% of assets as a management fee and 20% of profits as a performance fee. This can make hedge funds much more expensive for investors, especially when returns are high. Transparency is a hallmark of mutual funds. They are required to disclose their holdings, strategies, and performance on a regular basis, giving investors a clear view of where their money is invested. Hedge funds, conversely, are much less transparent. They are not obligated to reveal their strategies or holdings, which can make it difficult for investors to fully understand the risks involved. Liquidity refers to how easily investors can access their money. Mutual funds offer high liquidity, allowing investors to buy or sell shares daily at the fund's net asset value. Hedge funds, however, often have lockup periods and restrict redemptions to certain times of the year. This means investors may not be able to withdraw their money quickly, making hedge funds less liquid than mutual funds. Minimum investment required to enter a mutual fund is usually quite low, sometimes as little as a few $100s. This makes mutual funds accessible to a wide range of investors. Hedge funds, on the other hand, often require minimum investments of hundreds of thousands or even millions of dollars, limiting participation to wealthy individuals and institutions. Redemption policies are another area where these funds differ. Mutual funds allow investors to redeem their shares at any time, typically at the end of each trading day. Hedge funds, however, may only permit redemptions at set intervals, such as quarterly or annually, and often require advance notice. This can impact an investor's ability to access their funds when needed. Leverage is the use of borrowed money to amplify investment returns. Mutual funds generally use little or no leverage, focusing on steady growth. Hedge funds, however, frequently use leverage as part of their strategies, which can magnify both gains and losses. This use of leverage is one reason why hedge funds can be riskier than mutual funds. Short selling is a strategy where investors bet that a security's price will fall. Mutual funds rarely engage in short selling as their strategies are typically long-only. Hedge funds, on the other hand, often use short selling to profit from declining markets or to hedge other investments. This flexibility allows hedge funds to pursue returns in both rising and falling markets. Derivatives are financial contracts whose value is derived from underlying assets. Mutual funds may use derivatives sparingly for hedging purposes, but hedge funds often use them extensively as part of their core strategies. This can include options, futures, and swaps, which add complexity and risk to hedge fund portfolios. Performance goals of mutual funds and hedge funds differ. Mutual funds typically aim to match or slightly outperform a benchmark index, such as the S&P 500. Hedge funds, however, often pursue absolute returns, seeking to make money regardless of market direction. This difference in goals shapes their investment strategies and risk profiles. Tax treatment can vary between mutual funds and hedge funds. Mutual funds are required to distribute most of their income and capital gains to investors, who then pay taxes on these distributions. Hedge funds, due to their structure and strategies, may offer more tax deferral opportunities, but the specifics depend on the fund and the investor's situation. Always consult a tax professional before investing. Mutual funds must provide regular reports to investors, including annual and semi-annual statements, prospectuses, and updates on holdings and performance. Hedge funds, however, are not required to provide the same level of reporting. Investors in hedge funds may receive only periodic updates, making it harder to track the fund's activities and performance. Compensation for fund managers also differs. Mutual fund managers are typically paid a salary and a small management fee based on assets under management. Hedge fund managers, in contrast, often earn a percentage of the fund's profits in addition to a management fee. This performance-based compensation can incentivize risk-taking in hedge funds. Accessibility is a defining feature. Mutual funds are designed for the masses, with low minimum investments and broad availability through banks and brokers. Hedge funds, however, are exclusive, requiring investors to meet strict financial criteria and often to be invited to participate. This exclusivity shapes the investor base for each type of fund. Diversification is a key benefit of mutual funds, which typically invest in a wide range of assets to spread risk. Hedge funds may also diversify, but some focus on concentrated bets or niche strategies. The level of diversification can impact the risk and return profile of each fund type. Some mutual funds charge redemption fees if investors sell shares too soon after purchase, discouraging short-term trading. Hedge funds may impose penalties or gates to limit withdrawals during periods of market stress. These policies are designed to protect the fund and its investors from sudden outflows. The objectives of mutual funds and hedge funds can vary widely. Mutual funds often aim for long-term growth, income, or a combination of both. Hedge funds may pursue aggressive growth, market-neutral strategies, or even capital preservation depending on their mandate. Understanding a fund's objective is essential before investing. Mutual funds often manage large pools of assets from thousands or even millions of investors. Hedge funds, in contrast, may manage smaller amounts but with more concentrated strategies. The size and scale of a fund can influence its investment approach and the types of opportunities it can pursue. Investor protection is stronger in mutual funds due to regulatory oversight and disclosure requirements. Hedge funds offer less protection, as they are less regulated and cater to sophisticated investors presumed to understand the risks. This difference is important for those considering where to invest their money. Historical performance can vary widely between mutual funds and hedge funds. While some hedge funds have delivered impressive returns, others have underperformed or even failed. Mutual funds, with their diversified approach, tend to offer more stable but moderate returns over time. Past performance, however, is not a guarantee of future results. Mutual funds are suitable for a wide range of investors, from beginners to experienced individuals seeking diversification and professional management. Hedge funds, due to their complexity and risk, are best suited for sophisticated investors with higher risk tolerance and significant capital. Choosing the right fund depends on your financial goals and risk appetite. Sum up: mutual funds and hedge funds serve different purposes and cater to different types of investors. Mutual funds offer accessibility, transparency, and diversification, making them ideal for most people. Hedge funds, while potentially offering higher returns, come with higher risks, less transparency, and are only available to accredited investors. Understanding these differences is essential for making informed investment decisions. Thanks for joining us as we explored the key differences between hedge funds and mutual funds. Remember, the right investment choice depends on your financial goals, risk tolerance, and investment knowledge. Always do your research and consider consulting a financial advisor before making any investment decisions. Stay informed and happy investing.